Today, let's talk about making estimated tax payments for individuals and businesses. Let's take a look at the concept of estimated tax payments and why it is so important to pay them when they're due. An estimated tax payment is a payment you make to the IRS during the year based on an estimate that you owe. Like most taxpayers, you'll probably wind up overpaying and then receive either a tax credit or a refund at the end of the year. Payments can be made 4 times each year: in April, in June, September, and January 15th of the following year. Basically, it's a pay-as-you-go system. Obviously, it's in your best interest to make your payments on time, because failure to pay accidentally or voluntarily could result in a penalty. The biggest hurdle for most people is knowing what to pay. After all, it's just an estimate. Fortunately, the IRS for once gives you a break. Basically, if you pay what you paid the previous year, then you won't incur any underpayment penalties. This is because you're making that payment as a gesture of good faith. You can also pay 90% of what's due without incurring any interest penalties when you do actually pay the full amount. Lastly, if your tax amount is less than $1,000, you won't have to pay any underpayment penalty regardless. This is probably done by the IRS to reduce workload when dealing with small individual cases of underpayment. So whenever possible, make your estimated tax payments on time and for at least 90% of the total amount due. At least that way you can avoid the worst of any financial penalties. If you'd like to hear more, I invite you to visit us at www.gottaxes.com or 1-877-GOT-TAXES. Thanks.